£200 a month. That is around £6.50 a day. For a lot of people, that is a coffee and a meal deal. But for someone who starts investing that £200 every single month, it can quietly become one of the most important financial decisions they ever make. And in this video, I am going to show you exactly what happens to £200 a month when you invest it consistently over time. Not theory, not guesswork, actual numbers, because most people massively underestimate what consistent investing does to money over long periods of time. And once you see the numbers, it is very hard to look at £200 the same way again. Before we get into the numbers, let's talk about why most people never actually start investing. And it usually comes down to one of three things. The first is that they think they need a lot of money to start. Most people assume investing is something you do once you have thousands of pounds sitting around doing nothing. But that is not how most ordinary investors actually build wealth. The second reason is that they think it is too complicated. They hear words like ETFs, index funds, ISAs, and compound growth and immediately assume it is not for them. And the third reason is that they think £200 a month is not enough to make a real difference. Why bother investing a small amount when it feels like it will never add up to anything significant? And that last one is probably the most dangerous misconception of all, because £200 a month invested consistently over time can add up to something that genuinely changes your financial future. And the reason comes down to one concept: compound growth. Compound growth is probably the most powerful concept in personal finance, and it is also one of the most underestimated. The basic idea is simple. When your investments grow, those gains can also grow over time. So you are not just earning returns on the money you put in. You are eventually earning returns on your returns as well. And over long periods of time, this creates a snowball effect. Slow at first, almost invisible in the early years, but accelerating significantly the longer it continues. Let me show you what this actually looks like with £200 a month. Let us say someone starts investing £200 a month at age 25. They invest into a simple low-cost index fund inside a stocks and shares ISA, and let us assume an average annual return of 7%, which is a commonly used long-term estimate for diversified stock market investments. Now remember, returns are never guaranteed, and markets go up and down constantly, but over very long periods diversified index funds have historically produced returns in this kind of range. So what happens to that £200 a month over time? After 10 years, they would have invested £24,000 of their own money, but with compound growth, that could potentially be worth around £34,000. Already, that is £10,000 of growth on top of what they put in. But here is where it gets interesting. After 20 years, they would have invested £48,000 of their own money, but that could potentially be worth around £104,000, more than double what they actually put in. And after 30 years, they would have invested £72,000 of their own money, but that could potentially be worth around £243,000, over £170,000 of growth on top of their own contributions. And if they continued to 35 years, that £200 a month could potentially be worth around £354,000 from just £200 a month. That is the power of compound growth over long periods of time. And because this is inside a stocks and shares ISA, those gains would generally be protected from UK capital gains tax and dividend tax. Now here is the part that most people find genuinely shocking. The single biggest factor in those numbers is not how much you invest, it is how long you invest for. Time is the most powerful ingredient in compound growth. Let me show you what I mean. Person A starts investing £200 a month at age 25 and invests for 35 years until age 60. Person B waits until age 35 and invests £200 a month for 25 years until age 60. Person A invested for just 10 extra years, but at age 60, Person A could potentially have around £354,000, while Person B could potentially have around £162,000. Person A ends up with nearly £200,000 more from the same £200 a month just by starting 10 years earlier. That is not a small difference. That is a life-changing difference. That could mean more financial freedom, more flexibility, or simply more choices later in life. And this is why people who understand compound growth always say the same thing. The best time to start investing was yesterday. The second best time is today. Now, before anyone watches this and immediately transfers their entire savings into investments, there are some important things to understand. First, These numbers are not guaranteed. Stock markets go up and down constantly. There will be years where investments fall significantly in value. That is completely normal and expected. The numbers used in this video are long-term historical estimates, not promises. Second, investing is generally for long-term goals. The reason the numbers above look so impressive over 20 or 30 years is because compound growth needs time to work properly. Investing money you might need in the next 1 or 2 years is generally not a good idea. Third, before investing, it usually makes sense to have an emergency fund in place first. Most financial guidance suggests having around 3 to 6 months of essential expenses saved somewhere accessible before putting money into investments. And fourth, £200 a month might not be the right number for everyone. Some people can invest more. Some people can only invest £50 or £100 a month right now. The exact amount matters less than the habit of investing consistently over time, because the numbers still work at £50 a month or £100 a month. They just take a little longer to build up. So when you strip away everything, the message is actually very simple. £200 a month does not sound life-changing, but invested consistently over long periods of time, with compound growth working quietly in the background, it can build into something that genuinely changes your financial future. Most people spend £200 a month without thinking about it, on subscriptions, takeaways, things they barely remember buying. But redirecting even part of that into a simple investment account, started as early as possible, is one of the most impactful financial habits an ordinary person can build. If you want to get started, I have already made videos on how investing works in the UK, what a stocks and shares ISA is, and what an ETF actually is, so those are worth checking out if you haven't already. And in future videos we will break down exactly how to start investing in the UK, which accounts to use, and how to keep things as simple as possible. So if that sounds useful, make sure you subscribe. And thanks for watching.